Later today, we get the all important Fed decision. As we head into the decision, the overwhelming consensus is that the central bank will raise rates by another 25 basis points to the highest level in 22 years. This decision follows a pause after a period of 12 consecutive rate hikes. The big question will be just how much the Fed adjusts its policy outlook based on the latest inflation data, which has been trending down in a big way. The market has been pricing in a less aggressive Fed on account of cooling inflation, but this doesn't necessarily mean the Fed will be so easy to give up on its view that inflation still remains a problem that needs to be watched closely. And so ultimately, we believe market reaction will come down to what things look like in the months ahead. If the Fed hints at a complete pause for the remainder of the year, this is likely to be celebrated by risk assets, with the US dollar selling off across the board as well. If, on the other hand, the Fed isn't willing to let go of fears around inflation and signals another rate hike in 2023, we could see a sharp pullback in risk assets and concurrent rally in the US dollar. As far as the balance of risk goes heading into the decision, it does appear like the market has been leaning more heavily in the direction of pricing a more dovish Fed communication. And so this would suggest there is a greater probability for a bigger move towards risk off on a letdown than any risk on flow we might see if the Fed delivers as the market is wanting to see. It's important to remember that while inflation has come down quite a bit, this doesn't mean it can't turn back up after a healthy correction. Moreover, as the Fed eases up on policy, there is the risk that this will only invite another aggressive run in inflation back to the top side. So in the end, we believe the Fed will acknowledge the pullback in inflation, but won't be ready to rule out the possibility for additional rate hikes in 2023. That's all for now.